Today we are diving deep into a fascinating high-octane stock that has been on a wild ride. SEA Limited, ticker symbol SE. We've got a packed 16-minute show today, breaking down everything from their business model to technical charts, and we'll wrap up with a clear buy, sell, hold, or do nothing verdict for our viewers. Let's kick things off with the basics. What exactly does SEA Limited do, and how is their sector performing? Joining me, as always, is our brilliant co-host and lead market analyst, Sarah.
Thanks, Billy Bob. SEA Limited is essentially the digital ecosystem king of emerging markets. They operate three core segments. First, Shopee, their e-commerce marketplace, which is the absolute powerhouse, generating about 74% of their revenue. Second is Monee, their digital financial services and Fintech arm, contributing around 15%. And third is Garena, their digital entertainment and gaming division, famous for the hit mobile game Free Fire, making up the remaining 11%. Geographically, they dominate Southeast Asia, Indonesia, Vietnam, Thailand, the Philippines, but their fastest growing market right now is actually Brazil. As for the sector, the emerging market internet software and e-commerce space is highly dynamic but fiercely competitive. They are going head-to-head with giants like TikTok Shop, which is aggressively subsidizing prices, as well as regional players like Lazada and Tokopedia. In Latin America, their main rival is Mercado Libre, MELI. Despite the competition, the sector is growing rapidly as digital adoption accelerates in these regions.
Fascinating. It sounds like a classic razor and blade ecosystem. Now, let's move to our second point, business phase analysis. Where does SE sit in the corporate life cycle?
Based on the latest financial data, SEA Limited has officially graduated into Phase 5, capital return. This is a massive milestone. They are no longer burning cash to chase growth. Their operating income is strongly positive and expanding. Revenue is growing at over 30% year over year. And most importantly, they are actively returning capital to shareholders. Just in Q2 2026, they repurchased 4.7 million shares for about $416 million under their $1 billion buyback program.
That's music to a value investor's ears. Which brings us perfectly to our third topic, moat analysis. Warren Buffett always talks about the economic moat. Does SEA Limited have one, and is it widening or narrowing?
Our analysis classifies SEA's moat as narrow, but widening. They don't have an impenetrable wide moat yet because switching costs for e-commerce buyers are relatively low. People will jump to TikTok Shop for a discount. However, they have two powerful defensive positions. First, network effects. More buyers attract more sellers, which improves logistics density and attracts more buyers. Second, low-cost production. Their in-house logistics arm, SPX Express, is a game changer. In Brazil, they've reduced their cost per order by 21% year over year. That's a structural cost advantage that asset-light competitors simply cannot match without massive capital expenditure.
I love that. It's like Amazon building its own fulfillment network. Now let's talk about the future. Point 4, growth driver analysis. Where is the next leg of growth coming from?
It's a balanced growth strategy, but two drivers stand out as strong. First, geographic expansion. Brazil has reached an inflection point, achieving structural profitability in 2025. This proves the Shopee model is exportable beyond Asia. Second, new products/services via Monee. Monee's off-Shopee lending, meaning loans to people not even shopping on Shopee, grew over 300% year over year, now making up 15% of their loan portfolio. They are successfully becoming the primary credit card for the unbanked in emerging markets, with non-performing loans rock solid at just 1.1%.
That's incredible cross-selling. Let's look under the hood for point 5, business key financial metrics. Are the numbers backing up the story?
Absolutely. Let's look at the Phase 5 scorecard. Revenue 3-year compounded annual growth rate, CAGR, over 30% green. Free cash flow to net income over 90% green. This means their earnings are high quality, not just accounting tricks. ROIC, return on invested capital, over 20%. Green. They are deploying capital incredibly efficiently. Net profit margin around 5.9%, which is expanding as operating leverage kicks in. Debt to equity, a very manageable 17%. The financial engine is firing on all cylinders.
But no investment is without risk. Point 6, risk analysis. What keeps you up at night regarding SE?
There are two primary red flag risks. First, competition. The threat from TikTok Shop is real. They are engaging in subsidy wars, which could force C to ramp up marketing spend and compress those beautiful margins we just talked about. Second, outside forces, specifically regulatory risk. Indonesia, their largest market, has strict and evolving rules on e-commerce, foreign investment, and fintech lending. A sudden regulatory clampdown could disrupt operations. Management is mitigating this with AI-driven underwriting to freeze credit in high-risk zones instantly, but it's a risk we must monitor.
Prudent risk management is key. Let's shift to point 7, valuation metrics analysis. How should our viewers be valuing this stock today?
Because SE is now in phase 5, capital return, we must shift our valuation framework. We should prioritize trailing price to earnings, PE, and price to free cash flow, PFCF. These metrics reflect their mature, profitable, cash-generating reality. We should ignore price to sales, P/S. While SE trades at a P/S of about 2.6 times, which looks cheap, revenue multiples are for hyper-growth, pre-profit companies. SE has proven it can monetize revenue, so earnings matter more now. Currently, the forward P/E is around 31 times. That's a premium, but justified if the 25% annual earnings growth forecast holds true.
Great context. Now, point 8, price and sentiment analysis. Sarah, put on your CMT, Chartered Market Technician, hat for a moment. What is the tape telling us, and how does sentiment look?
Putting on my CMT hat, the technical picture is a classic tale of two time frames. Over the last 12 months, SE hit a 52-week high of $199.30, but has since corrected sharply to its current price of around $115.68. It is currently testing a major historical support zone between $110 and $115. From a sentiment perspective, we have a massive divergence. Momentum indicators like the Zacks rank are flashing a 5-strong sell. Why? Because over the last 60 days, 100% of analysts have revised their EPS estimates downward, and SE has a history of missing earnings by about 15%. Momentum algorithms hate downward revisions. However, from a contrarian technical view, when a fundamentally strong stock gets beaten down to major support while bad news is already priced in, it often forms a base. We are watching for a bullish divergence on the RSI and a decisive breakout above the 200-day moving average to confirm a trend reversal.
That's a brilliant technical read, Sarah, which leads us to our final analytical point, number 9. Analysts' price targets and discounted cash flow, DCF. What's the math say?
The math is highly compelling. According to Simply Wall Street's DCF model, the intrinsic fair value of SE is estimated at approximately $182 per share, with some models ranging up to $208. At $115.68, the stock is trading at roughly a 36% to 44% discount to its intrinsic value. Furthermore, the average analyst price target is around $153, with some recent narrative updates from firms like Barclays nudging targets as high as $192. So even the conservative street targets imply a 30% plus upside from current levels.
All right, let's bring it all home for our viewers. I want to look at this through the lens of two legends, Peter Lynch and Warren Buffett. From a Warren Buffett perspective, he would appreciate the widening moat, the owner-operator mindset of CEO Forrest Lee, and the fact that the company is now generating massive free cash flow and buying back shares. However, Buffett strictly adheres to his circle of competence. He might shy away from SE due to the unpredictable regulatory environment in Southeast Asia and the intense, subsidy-driven competition from well-funded tech giants. It's a bit too hard for a classic Buffett pick. From a Peter Lynch perspective, however, SE is a dream. Lynch loved fast growers that are transitioning into stalwarts. He would look at a company growing revenue at 34%, expanding into a massive new market, Brazil, profitably, and trading at a reasonable multiple relative to its growth rate, a classic GARP play. Lynch would say, the story is intact, the balance sheet is strong, and the market is overreacting to short-term estimate revisions.
I completely agree, Billy Bob. As a CMT, I also look for asymmetrical risk reward. The downside seems capped around the $100 to $110 support level, while the upside to the DCF value of $182 offers nearly a 60% potential return.
So, Sarah, the million-dollar question for our viewers: buy, sell, hold, or do nothing?
Here is the actionable verdict. For existing shareholders, hold. Do not sell into the weakness. The fundamentals are improving, and the buyback program is putting a floor under the stock. For aggressive growth investors, buy. Initiate a starter position here around $115. The 40% discount to DCF value and the Brazil inflection point make this a compelling entry. For conservative income-focused investors, do nothing. Wait for the next earnings report in November. If management guides positively and we see a technical breakout above the 200-day moving average, that will be your safer confirmed entry point.
Fantastic breakdown, Sarah. C-Limited is a perfect example of why we must look past short-term momentum noise and focus on long-term business value, cash flow, and widening moats. That's all the time we have for today's deep dive on Build Wealth Now News. If you found this analysis helpful, smash that like button, subscribe, and ring the bell so you never miss a wealth-building opportunity. Until next time, keep building your wealth and stay disciplined.
See you next time, everyone.
Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.